Welcome back. It's April and it heralds the start of the earnings season. And first of the block is always TCS. And this time TCS comes out with its numbers on 10th, which is a market holiday. So, that's next Thursday when we'll get to know more. But, expectations going into the earnings season are quite low. Just pull up the UBS numbers. They're expecting constant currency revenue growth to be negative for all the large cap IT companies. And even the guidance for FY26 is likely to be very conservative and soft. So CLSA is anticipating Infi to guide for a 2 to 5% kind of top line growth, HCL Tech at about 3 to 5%. The macro has gotten a lot tougher. So let's talk about, the India domestic story, the IT earnings, the overhang from global weakness. Prateek Parekh from Nuvama Group is joining in to talk about individual sectors and markets on the whole. Prateek, thank you very much for joining in. Before we get to the market, you all have recently downgraded the IT sector to an underweight. Take us through the call and what you expect and how you expect IT to perform.
Yeah. Hi, Rima. Thanks for having me over. So yes, IT was one of our anti-consensus overweight last year. It gave us a very good alpha last year per se. So I think when we started the year, we did move IT lower to neutral, and now we have moved to underweight. Our rationale for the same is that in IT sector, we were hoping for margins to see further improvement and growth to come back because the US recession concerns or US corporate profitability, which was under big pain point last year, had seen an improvement. Why we have changed the call is because valuations have reached their post-COVID peak. CC growth, constant currency growth still remain on the lower side, and margin stabilization owing to very high attrition that was there. I think that tailwinds are behind. And as a result, given the current circumstances where IT companies' starting point of valuations, both absolute and relative, are on the higher side, growth concerns are dominating and fresh uncertainties have cropped up, we have moved the sector to underweight per se, Rima.
Prateek, within the IT pack, is it all-round underweight stance, or do you have a preference within large cap and mid cap names? Do you think mid cap can fare better this year?
Yeah, that's a very good question per se, because what's been very unique about post-COVID recovery is the rise of mid-cap IT. Mid-cap IT companies have really grown up the scale and have delivered very well on the growth front. Even their capital allocation decisions to some extent have been better, where they have been more aggressive on acquisitions and getting the right strategy in place. So I think obviously, if growth is a concern, then I think even mid-cap and large cap both will take a hit. Mid-cap valuations are on the higher side, but so far they've been delivering better growth. So I think right now we are cautious on the entire pack itself per se, but I think we'll get more clarity on whether mid-cap IT can continue their outperformance, once we move in the later part of the year or once the dust on the current uncertainties potentially settles down.
So that's the call on IT. Meanwhile, you'll have also upgraded your assessment on consumer. What's it premised on?
So I think consumer stocks, we have, moved our weights, not entirely because we are very bullish on the overall consumption revival, but owing to 2 or 3 factors. One is that consumer stocks have underperformed. So to that extent, the starting point is better. Second, whatever the government policies are incrementally more focused on supporting the consumer rather than the capex, whether be it income tax cuts, whether be the welfare schemes of the states, so on and so forth. And the third factor is that if there is, global growth turmoil, which seems quite likely, in that scenario, you generally see commodity prices cooling off, and also Nifty earnings weakening. In that scenario, consumers typically provide a good hedge against the drawdowns per se, Rima. So I think it is more of a relative call rather than necessarily absolute call. And given in the current context, we think that is more favorably placed.
Prateek, any specific view on pharma and any favorites within the pharma pack? Tomorrow is a big day for the entire space. Yeah. Reciprocatory tariffs is something that we're talking about. So how are you positioning and how are you advising clients position themselves ahead of this particular tariff announcement?
Yeah. So I think clearly tomorrow, yes, the whole world is looking up to tariff announcement. Now, tariff announcement has 2 parts. One is the micro and the second is the macro. What I mean by that is the micro is the which sector, how much tariffs is imposed. And the macro is what it means for the overall demand, capital flows and the risk appetite. I think predicting micro impact is very difficult because even if you impose, let's say, tariffs on pharma sector, there are multiple second round, third round impacts involved, and the knee-jerk reaction may perhaps be misleading going ahead. I think what we need to look out for is the macro impact, which is that if there are meaningful tariffs imposed, then you are likely to see retaliation coming from global partners as well. And the big takeaway is going to be the weakening of global growth, which has already been weak. Now, this has very meaningful implications for BSE 500 companies' top line because a large part of our top line is globally tradable. And if global growth weakens, especially at a time when domestic demand is probably not in the best of the health, I think you can see earnings disappointments. So I think for our advice to clients is focus on the macro rather than micro, and global growth impact and risk appetite, I think, will be a bigger point to look for rather than necessarily what is impacting which sector per se, Rima.
Prateek, you all also overweight private financials. You would have seen that Uday Kotak tweet, which went viral, where he's cautioning or warning, how banks could get impacted because of low deposit accretion. What are your thoughts on banks, and what is the driver behind this overweight call of yours?
Yeah. So I think private banks clearly, they have been have been through a very big deposit lull phase for I think 2-3 quarters now. In our view, the main driving force of deposit lull has been the tight liquidity situation. The banking sector liquidity or overnight LAF has been under deficit for now more than 2-3 quarters. Initially, it was because of government cash balance, ramp up. And second, in the last couple of quarters, it was mainly because of RBI's heavy forex interventions, which drained the domestic liquidity. Our view is that the worst of that is possibly behind because RBI has been injecting a lot of liquidity per se. Although material improvement will still need global support and global capital flows of sorts, but at least we think the worst of that is behind. Our rationale for overweight private banks is, that these are very quality franchises and who have demonstrated across cycles, resilience in their business models and their profits per se. Second, what we are more optimistic on private banks is that if you look at in F23 and F24, private banks' core operating profit or PPOP, as they say, that has slowed down materially despite loan growth being very strong. Because all these guys opened up a large number of branches, did the capex, which is the right thing to do in a rising credit cycle. And now we think that at least the capex part of it is behind. So there are cushions on the cost front, which are there to offset some of the top line slowdown per se. And that's where we think private banks fits in the category where low growth is currently in the price, and there are more chances of it stabilizing or potentially even improving rather than worsening of sorts per se. So it's a category where low growth and low valuation and things are moving directionally, at least I would say, not deteriorating and moving perhaps on the brighter side.
Okay, got that. What about the market? I was going back and seeing some of the notes. In August of 2024, you had said that India's valuations, absolute breadth and relative, are at extremes. The market cap to GDP is at 150% at an all-time high. And the previous peak was in 2007. And at that time, too, the market cap to GDP was 150%. And soon after, the correction ensued. But now that we've seen a correction of 10-15%, what is the call that you're making on the markets?
Yeah. So again, that's a good question, Rima. So I think on the markets, our main point is that for markets to turn around, you either need very strong earnings revival or you need very large policy easing or rates being lower. Absent both, markets can remain range bound or move lower. In FY24, while interest rates world over, both in US and India, remained elevated, what we got was a very big improvement on the earnings front, mainly led by margin tailwinds. In F25, what we have seen so far is that the earnings have slowed down. Interest rates, on the other hand, if you look at it, while central banks have cut rates, but you still have the 10-year bond yields being very elevated. So in some sense, we are having a phase where valuations have cooled off from their peaks, but are still on the higher side. Earnings momentum remains weak, and even the outlook perspective, we don't foresee a big improvement on the earnings front, and interest rates are elevated. In this combination, it is very difficult to be constructive or to have a very meaningful gains over a next 1 year perspective. Our view is that going ahead, policy support is trickling in, but I think the pace of that is more important. It's only when you have policy rate cuts being very meaningful that you typically get a turnaround in markets. And at least in our view, we think this is still some distant away, and to that extent, we are still on the cautious side on the markets per se, Rima.
Thank you so much, Prateek, for joining in, sounding a very cautious note as far as FY26 is concerned. With that, let's slip into a short break.